Similar to the last case study with IBM, this chart has a strict double top lining up with a single downswing to form a more spread out triple top reversal. This was accelerated due to the context of the large downtrend before it. The major downtrend holds down Intel despite some sizable bullish reversals later on. The first bullish reversal concentrates around the 21 to 19 range. It comprises a double or triple bottom, depending on how strict criteria is for the alignment of the second upswing. Then the range transitions to an ascending triangle to fill in the gap down. That completes the bullish reversal range at the end of 2004. The second highlighted bullish reversal range, from the end of 2008 to early 2009, is a plain flat bottom comprising of a series of double bottoms. Price action doesn't always stay neatly contained within the bullish reversal range. That is still relatively clear. Naturally, the old ranges become useful references for resistance as an overall uptrend begins the new decade. Here is an example of a declined triple top transitioning into a flat top range that begins an accelerated downtrend after a gap down closes under the lower boundary around 35.50. Downtrend lines from the formation are useful in precisely identifying later areas where resistance is stronger due to the intersection of downtrend lines and previous levels of significance. Overwhelming ascending triangle price action accelerates an uptrend to surpass another intersection of a downtrend line with a previous level of significance that now provides support to a recent gap down. Again, this is one of those cases where an uptrend line shares the same trajectory as an ascending triangle. So technically, the ascending triangle doesn't start in February to reverse the downtrend. Rather, it begins closer to April or May, when it continues the February upswing to break over the 32 area. This creates a familiar bullish continuation outline with an inclined slope, gradually rising over a defined resistance range and ending with a bullish acceleration. Also, similar to the past example with IBM, there are examples of gaps, starting and ending patterns for extra volatility and strength. In this case, it is a head and shoulders formation from September to October. After an extended period of range-bound trading, there is a potential break over the long-held 37 to 38 range. As usual, this range now becomes the key barrier to stay over to increase the chances of establishing to new highs. A solid week of higher closes completes a large-scale ascending triangle that still produces the characteristic aggressive incline after breaking over the upper boundary that was the 37 to 38 range. A double top reversal with a wider lower boundary from the gap up was avoided, but the same range is still under pressure from the most recent downswing. For the meantime, the gap up from October is not filled as price action is mostly contained over the lower 40s. From late January to early March, another potential double top reversal is avoided as the 47 level holds. 47 becomes a crucial support to halt yet another double top reversal towards April. The wider low to mid 40s ranges also have a significant impact during several major downtrends in the following years. The old levels in the 40s ranges are quite precise, as many volatile candles drop onto 47.20 and 44.40 to form opening and closing prices very close to these levels. This just demonstrates increased volatility of the range in a long-term context. As usual, there is neutral to bearish price action following the break of an uptrend line. It would seem inevitable the 47 level would be recontacted, but a drastic decrease in selling volume into June contributed to the bearish weakness. Another similarity to the previous IBM example is seen with the completion of a head and shoulders with a gap down. As would be expected, there is immediate support from the 47 level. This was a more difficult head and shoulders to identify during its formation, like the IBM example, because even though it was a fairly symmetrical outline, it was comprised of several minor horizontal ranges. As usual, there are helpful references from gap levels and a downtrend line from the head and shoulders. A precise identification of firmer resistance around the intersection of the downtrend line and the 54.25 level, as an accelerated downswing takes Intel back to the key 47 level with another strong gap down. As is so often the case, the gap downs were due to negative reactions in the market following quarterly earnings reports that served as the primary catalyst in sustaining the aggressive downtrend. This is why the old downtrend line remained highly influential, even as a sizable recovery began in the lower 40s ranges that were the natural site of more support. After the 47 level was decisively broken with overwhelming bearish context, a solid uptrend develops but will of course encounter noticeable resistance at previous levels of significance, mostly from the gap down and head and shoulders ranges. Ascending triangle outlines reveal the areas of strong bullish breakouts, one of which is from a positive response to an earnings report. Though as expected, even the bullish surge following the early 2021 gap up finds considerable opposition from the gap down fill at the 60 boundary, along with the shoulder level of the head and shoulders.